I did it. I own 43 Dividend stocks. I bought Honeywell today, ticker symbol HON. I'm going to share with you today my fundamental dividend stock analysis that shows precisely the financial metrics that I analyzed with Honeywell before I purchased this stock. Let's get started with an exciting dividend video. I want to do a deep dive into Honeywell today and the theory, the fundamental analysis, the thought that went behind adding position number 43 to my portfolio. So this video, it's going to be a combination of fundamental analysis and high-level insights. I want to start with a high-level insight here. You guys know oftentimes I like to buy a stock when it's falling off a cliff. I like to buy it when the share price is down, when it's under a lot of pressure, when value is created. You've seen that this year just in 2019 with stocks like 3M, stocks like Cedar Fair, and stocks like AbbVie. Those three actually are starting to go back up already, but I hope they stay down because I want to accumulate more shares. But sometimes when a stock falls off a cliff, it's indicative of value. It doesn't mean that there's value there, but it's sometimes indicative that, hey, you really, Ian, ought to look at the fundamentals, see if there's value there. And I found value with 3M, Cedar Fair, and AbbVie, and it just so happens that when the stock went down, value was created. That's not always the case, though. Sometimes a stock can fall off a cliff and still be overvalued. But the reason I'm excited about Honeywell is the stock's actually been trending up, but I still think there's value. And so sometimes I think investors, they get scared of buying a stock when it keeps going up, 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 and up. But the picture that I'm trying to paint here and the tip for everyone to take home today is don't necessarily only look at stock charts. Stock charts are nice because they kind of give a leading indicator. What does the market think right now? What is the sentiment in the market? But even a stock that is trending up, sometimes it can be a value stock. It can be a reasonable value. It can be a good value. It can be on sale. I wouldn't say Honeywell is on sale here, but I would say it's a fair price, a fair value. We'll get into that in a minute. But that's one of the takeaways from the video at a high kind of qualitative level today. So one of the things I want to discuss with Honeywell is I really love this company from a dividend standpoint. They just raised the dividend today. They raised it by 9.8% up to 90 cents a quarter. And so this is a dividend growth company. In fact, this company, the 5-year compound annual growth rate for the dividend before the most recent one actually, in fact, this does actually include the most recent one, is 15%. And so the 5-year compound annual growth rate for Honeywell, again, for the dividend is 15%. On average, they raise it by 15% per year. And so fabulous. And that includes the most recent dividend increase today. And so I'm so happy to see that. The starting yield on this stock, it's not very high. It's not going to drive a lot of cash flow for me overnight. It's not going to make or break my portfolio overnight. But this is the kind of stock that I can accumulate. I can set it and forget it. I can come back in 20 or 30 years and my yield on cost can be phenomenal because they raise the dividend so quickly. And they'll continue to do that, in my opinion, because the payout ratio is low and the growth rate of the company is high. And so I want to start out today actually with a comparison of just Honeywell versus some of the other industrial stocks that I own that are kind of similar, somewhat similar peer group type stocks. So I'm going to show that on the screen now. And I'm going to compare Honeywell to 3M to United Technologies. And so these are all three, not the only industrials I own, but 3 industrial companies that I own. And by the way, the price per share in Honeywell here is 168.04, but I actually initiated my position at 166.56. So it raised, the price raised throughout the day and ended the day a little bit higher than where I bought it. But needless to say, mostly the same, similar to where I bought it. And so when you look at these 3 companies, I'm not going to go through every single metric, but what I'm trying to show here are some interesting factors. I want to show the market caps. I want to show the earnings per share. I want to show the dividends, the dividend yields, and compound annual growth rates, payout ratios. And so what you can see here is Honeywell, it is the lowest starting dividend yield at 2.14%, but the payout ratio is also the lowest, and the compound annual growth rate is the highest on the dividend. And so just from a dividend standpoint, Again, I don't choose stocks based on dividends. I choose stocks based on fundamentals, but I choose stocks that tend to be dividend-centric companies. And so we're going to get into all the fundamentals on Honeywell later, but I want to start the dividends because ultimately that's the goal of my investing, is to pay for stuff with dividends. And it's just interesting. You see kind of a tale of three companies here. Honeywell, it may not be paying a huge dividend right now, but the growth rate is there and the payout ratio is low enough to sustain that. But you contrast that with something like 3M, and it has a higher starting yield, but the payout ratio is higher, growth rate is a little bit lower, but it's still amazing. But you just kind of see, hey, 3M probably doesn't have as much room to grow the dividend as Honeywell. And so again, Honeywell, it really leans into the area of my portfolio that is centered around rapid dividend growth, yield on cost, long-term buy and hold. Not going to pay bills with this cash flow now, but in the future, I certainly will. By contrast, something like Cedar Fair, Master Limited Partnership I own, has a huge dividend, and I could theoretically use that cash flow right now to pay bills, although I am reinvesting it manually back into Cedar Fair, but I'm reinvesting it. And so that being said, I just want to compare something like a Honeywell to a Cedar Fair, very different companies. Honeywell is clearly a dividend grower. And so in terms of PE valuation, you'll see on a 2019 PE basis, Honeywell is the highest PE, 3M next highest, and then United Tech the lowest. And 2020, same trends. In general, I think these PEs are pretty reflective of growth rates. In fact, Honeywell, I would say, is the quickest growing of the bunch in terms, most likely, of revenue and other important financial metrics. 3M, next highest grower. United Tech, maybe a little bit slower. And so you can kind of see, I generally believe that the market is not efficient, that it's inefficient, but sometimes there's snapshots in time where it is relatively efficient. I think the market is pricing these three stocks relatively efficiently. They're pricing them really on the growth rates. And so you can kind of just see how they stack up here. Really what I was trying to do is make my industrial exposure in my portfolio a little bit more robust, add more dividend growth, add, quite frankly, a company that I look to as a tech company. I look at Honeywell as a tech company. We'll get more into that later, but they are in aerospace. They are in building materials. They are in safety products. They are in the Internet of Things. They're doing a lot as it pertains to software, in fact. And so Honeywell, they're an innovative company. They're a tech company, in my opinion. They just approach technology a lot differently than a pure play software company, if you will, or a pure play internet company, if you will. And so I want to move on here. First, though, just a quick note on diversification. I own 43 stocks now. I've been on somewhat of a buying rampage as of late. I bought so many stocks in 2019. I'm up to 43. I'm at the point where I want to start slowing down because if I add too many stocks to my portfolio, each position does not carry as much weight, as much meaning. But I'll tell you, why did I add Honeywell? There's really two reasons. One, I wanted more exposure to industrials, and so I'm going to share on the screen here my current portfolio allocation to industrials. And you'll see these are the industrials that I own. I own 3M, Caterpillar, Leggett & Platt, United Tech, and Honeywell. And so when I add all these up, portfolio allocation, obviously Honeywell real small, just started today, just a starter position. I'll tell you, reason though I got into Honeywell, quite frankly, is once I own a stock, it makes it easier for me just to add more. It's that momentum I've been talking about. It's drawing the line in the sand that I've been talking about. And quite frankly, if Honeywell stock at some point does fall off of a cliff, the chart starts trending down, there starts being a little more value, although I think it's a reasonable value right now. It's just easier for me to buy more shares when I already have that starter position. And so that's why I got into it. But I also got into it here, you'll see, because my industrial exposure is only at 7%, 7.25 of my total portfolio. I'd like to see my allocation to my portfolio in industrials higher, more well-rounded. And certainly I could have done that by just adding more to 3M, for example, but I wanted to round it out with Honeywell. I'll tell you another point on all of this is there is some uncertainty with United Tech. I added a lot of money actually to United Technologies earlier this year. I'm happy that I did. I still feel that it's a reasonable value in the marketplace. But with it splitting up, it's no longer an industrial conglomerate. It's going to be three separate companies: an aerospace company, an elevator company, an HVAC company. And so I'm kind of lacking in my portfolio with that upcoming United Tech split an industrial conglomerate. And so I really like Honeywell because it is that traditional industrial conglomerate. And surely you could say 3M maybe has a little of that going on, but they're more into adhesives and things of that nature. Whereas at Honeywell, they're literally producing aerospace parts. They're literally producing building components like thermostats, for example. And so, I wanted more exposure to something like a traditional industrial conglomerate, and I kind of had that with United Tech, but now that they're splitting up, I kind of have it because I'm going to keep all three companies, buy and hold forever. But still, I wanted something that was that pure play conglomerate. Okay, and so how did I start? Now I know, hey, I want another industrial. I like Honeywell. I want to add to the portfolio. How did I actually start looking at the fundamentals to determine, is this the right company for me? Is this the right company for my dividend stock portfolio? So I started by reading the 2018 annual report, the 10K, if you will, but I also read all the preamble that comes before it in the quote unquote annual report. If you just look at the pure 10K, sometimes it doesn't have all that preamble stuff. And so I wanted to look at both annual report and the 10K. In the notes from the management team and the CEO, I had some really good insights that I picked up I want to share with you. Quite frankly, there were some unique insights that came from the Honeywell report that I thought were really special. And they actually kind of reframe how I look at this company, but how I look at some other companies as well. And so we'll get to that a little bit later. But it really comes down to free cash flow conversion. I just plant the seed here, but they talk a lot about free cash flow conversion, and I like why they do that. I think it's rare. It's rare to see a company do that, and I think they're doing that to be very transparent about their stellar performance. So we will get more into that. Now, the organic sales growth is 6% year over year at this company. Let me explain this. Organic sales growth is really important because it takes currency fluctuations out of the picture. It takes acquisitions out of the picture, but it also takes divestitures out of the picture. So they've sold off business units. It takes that out. It looks apples to apples. How is this company growing on a constant currency basis year over year? 6% revenue growth. For a company of this size, which is a $120 billion company, interestingly, it's bigger than 3M, which is at $94 billion, and it's similar to United Tech, which is $117 billion before they split it up. $120 billion company to be growing 6% year over year on an organic basis. That is pretty cool. That is pretty thug life, if you ask me. Now, one of the things that was really interesting is they talk about this free cash flow conversion. They have 100% free cash flow conversion in 2018. This actually was a strategic imperative of this company. And what does this mean? Basically, what it means is as compared to net income, free cash flow is it's on par. It's 100% of net income. And so the reason they point this out, and this is so important, is there are games that can be played with net income. Net income, it can be messed with. The books can be made to look like the company is earning more than it really is. And so the beauty of looking at cash flow is it's literally cash that is coming through that could be tangibly used for real expenditures. And so sometimes what you see when you look at a company is, hey, net earnings look good, but free cash flow, it's not very good. And oftentimes you see a company where net earnings are going up, cash flow is going down. Ultimately, net earnings aren't going to pay bills. What's going to pay the bills are the cash flow. And so what this company is stressing in their annual report is not only is revenue up, not only is net earnings up, but free cash flow conversion, it's on par now with net earnings. It's 100%. It was lower in prior years. We'll see this in a minute with some data I'm going to share on the screen. But the net earnings are going up, and the free cash flow is going up too, and the free cash flow conversion is going up because it's improved to 100%. And so this is a company that is really trying to brag about their results through this metric, saying that, hey, we're not messing with net earnings on our books. We're going to show you our free cash flow, and we're going to show you that it's at parity with the net earnings. And so I was really impressed to see this. This opened my eyes. This was a way that this company frames thing that I haven't seen other companies frame it this way. This is why, honestly, if you want to be a better investor at home, just read 10Ks. Honestly, read them, read all the fine print, go into the details, because you can learn so much. And I'd never really singled on this kind of notion of this free cash flow conversion, but Honeywell really got me on this bandwagon, and now I am all about that. And it's really interesting to see, and I really appreciate that Honeywell stresses that. So really cool to see. Now, they outlined 6 strategic goals in their annual report. And quite frankly, hey, strategic goals, this and that, whatever. But the reason I like their strategic goals is they emphasize something. They emphasize dividend growth. One of the strategic goals of this company is providing dividend growth. This company cares about the shareholders. This company wants to reward the people that own the company. This company wants to produce results. They want to produce higher free cash flow conversion. They want to produce more free cash flow, more net earnings, more revenue. They want to do all of this because it allows them to raise the dividend. And so having a company that's dividend focused, that is focused on the dividends, focused on rewarding shareholders is so important to me. It is so critical. And personally, I believe that companies that focused on dividends tend to be better companies. And I think Honeywell is a stellar example of this dividend irrelevance theory. In my opinion, this is one of the arguments against the dividend irrelevance theory. We talked about this in a recent video, but here it is in real terms in the 10K. This is a company focused on dividend growth, and it tends to be a really well-performing company, quite frankly, because they're focused on dividend growth. And so one other thing that I saw in here is just nice to see that they're embracing organic growth, and they're embracing that free cash flow growth. And so I love their strategic goals. They are all aligned with what I would want to see as a shareholder. So one of the other things that was interesting is they mentioned something about the dividend in their annual report. And it was a sentence that goes like this: the 10% dividend increase in 2018 represented our 9th consecutive double-digit increase since 2010. Well, they just raised the dividend today by another 9.8%, rounded up to 10. Now, this is the 10th consecutive double-digit increase since 2010. This is a dividend growth company. No one's making huge money on the dividend yield right now, but yield on cost is going to be huge because they're growing it. They expect in 2019, by the way, strong growth in the following categories: aerospace, warehouse automation, sensing, and Internet of Things, or IoT, and software. And so again, this is a tech company. Sure, they do things that are like high tech, perhaps. They sell, for example, like safety gear, and I'm sure some of that gear is really tech centric. Some of it might be more basic, but basically, sometimes people ask me, Ian, why don't you own technology companies? Personally, I believe that a lot of these industrials I own are technology companies. Certainly Honeywell, certainly United Tech, where they're in aerospace. Oh my goodness, that's the forefront of technology. Some of that technology, in my opinion, is more cutting edge than an internet company. And so, just my personal opinion, but it's really respectable tech. It's pretty cool stuff. And so 3M, even, that's a tech company as well. They're always innovating on their adhesives and such. And so that's all good stuff. So what I want to do next is I want to move into an analysis of the numbers. And this analysis, I'm going to share it on the screen with you all. It's going to discuss, first, I just want to go through the income statement, if you will, and income statement related metrics. Some of the cash flow statement gets on here too, but basically I want to show you a time series of how this company is performing over time from really an income statement centric approach. So I'm going to show this on the screen. This is all stuff I pulled from the 2018 annual report. And so the first thing was just the organic sales growth. And so organic sales growth, again, is very important with this company because they've made acquisitions, because they've spun off units, because currency fluctuates over time. And so I want to see apples to apples. Is it really growing on a year-by-year basis? Well, I don't have the numbers for 2013. I'm sure if I looked at old annual reports, I'd get it, but I was just looking at the 2018 annual report. Organic sales growth is really good. It was 3% in 2014, 0% in 2015, negative 1% in 2016, 4% in 2017, 6% in 2018. So some years it doesn't have it, it's flat or it's slightly negative. But 3 of these 5 years it had stellar organic sales growth. 3% in 2014, 4 in 17, and 6 in 2018. It's accelerating. So I like to see that. The net sales are when I look at raw net sales not adjusted organically, when I compare 2018 versus 2013, so 5 years have elapsed, 7% total growth of sales. But I think, again, that underestimates it because it's not organic sales growth. Operating income is up a staggering 30% over that period. Operating margins are solid. They've increased from 13% up to 16%. I'd love to see a company that's increasing the margins. They're getting more effective. Revenue doesn't have to grow quite as quickly if you can squeeze more money, more profits out of the revenue you have. And so they're doing that. They're not only growing revenue, but they're making their revenue more productive by expanding margins. Adjusted net income is up 52% over this period. Just staggering. This is a growth company again. Growth company, which allows it to be a dividend growth company. The net margins are fabulous. They've gone from 10% up to 14%. So net margins have increased 42%, staggering 42%. The adjusted free cash flow is up 78%. Oh my goodness. And so again, this is why they're touting the conversion, because their free cash flow conversion's gone from 86%. So in 2013, if you look at the adjusted free cash flow, it was $3,388. Net income, adjusted net income was $3,960. And so the cash flow was 86% of the net income. But fast forward to 2018, the cash flow is 100% of net income. And so there's a few things happening here. Top line, the revenue is growing. Right below that, operating margins are improving, so they're eking out more profit. Below that, net income and net margins are increasing. And so, again, they're being more efficient with the business they've got. And then, going even deeper into this thing, they are getting better about their cash flow conversion. And so you have this machine that is just getting more and more efficient while the whole ship is growing, and it catapults your cash flow over the course of 5 years by 78% growth. And so, again, this is a growth company. It'll be interesting to see if these trends continue the next 5 years. But my assumption is that perhaps it won't be as good as the last, but it will be, I think they're going to do just fine. I think they're going to continue to exhibit growth. And I like adding a little bit of growth to my portfolio when some of the companies I have are a little bit slower. I like to mix them and match them. And so next, I want to share with you some of the risks associated with this portfolio. One of the things I always like about 10Ks, they talk about all the risks. And sometimes the risks, honestly, what they talk about, it's just boilerplate. It's not very interesting. It's not very exciting. They're like, hey, there's risks because we're a business, and risks come with any business. So you decide to skim through the boilerplate. But sometimes in those risks, things pop out that give you an insight about the company. And so one of the insights that came out of the risks was, we have risks related to our defined benefit pension plans that may adversely impact our results of operations and cash flow. And so, in general, companies with pension plans, honestly, not my favorite, but this is a company that's been in business for a long time. They got these pension plans. These pensions sometimes can be really big, and oftentimes they're not funded properly. I didn't dig into the pension plan too much with Honeywell, or quite frankly at all, but seeing it pop up at a risk, I'm like, okay, something I need to be aware of. Is it a deal breaker for me? No, be aware of it though. So they also said our future growth is largely dependent on our ability to develop new technologies and introduce new products that achieve market acceptance in increasingly competitive markets with acceptable margins. Nothing that special about this. This is kind of boilerplate, but the reason I'm highlighting it is this is a technology company. Again, Honeywell, in my opinion, is a technology company. And what they're saying here is we need to innovate. We need to put new technologies, bring new technologies to market to grow our company. Quite frankly, I think they need to bring new technology to market to sustain it. not even to grow, just to sustain it. This is what carries more risk with tech companies, this type of thing, because an old school company like a Coca-Cola, for example, they don't need to really innovate. Their product is just going to keep selling. And so the point being, Honeywell, it's not a Coca-Cola. Honeywell, they need to innovate to keep selling. And so this is, and quite frankly, to grow, but not even looking at the growth. And so it's important to point that out. This is why tech companies come with more risk for sure. And so it was also nice that they pointed out, as a supplier of the U.S. government, we are subject to unique risks such as the right of the U.S. government to terminate contracts for convenience and to conduct audits and investigations of our operations and performance. They work with the U.S. government. Risks come with that. It's worth noting. It's just good to know that same risk applies to some of the other industrial companies that I own as well. And so just good to know. Now, how much of their business comes from the government, I didn't really look into that, but maybe that would be a further piece of due diligence that I should be doing in the future. Look, you can never look at everything. You have to look at what you can look at, make your best judgment. And so that's a qualitative macro level takeaway, is I do the due diligence I can, but I'm not going to get into analysis paralysis and delay this any longer. I've been wanting to buy Honeywell now for probably over a year. And so it's time. And it's not a screaming value. It's a fair value, 20 PE in this market. Maybe you would say it's overvalued. Hey, it's a line in the sand. It's a very small starting position. It allows me now to be more attuned to what's going on with Honeywell. And quite frankly, when it does drop or present more value, I can jump at it. And so I want to talk now about something else I saw. I saw share repurchases. This company's repurchasing shares. And so I do not believe that they are doing this by issuing more debt, because I'll talk about this later, but when I look at the balance sheet, the debt is actually going down. And so they're doing a good job at paying off their debt and keeping their debt really low. Something I loved about this company is I think they have a stellar balance sheet. The reason I'm actually pointing out these share repurchases is a lot of companies, they get a lot of negative criticism for repurchasing shares, because a lot of companies, they're repurchasing shares at really high levels and they're using debt to do that. The thing about Honeywell is they've repurchased all these shares in 2018, but check it out. They bought it at attractive prices. And so right now, Honeywell is trading at 168 and change, but the shares are repurchased. Biggest tranche at 156, next biggest tranche at 146, smallest tranche at 143. They purchased it at lower levels. I always like to see repurchases at attractive levels. It means they're not just repurchasing to repurchase. They're repurchasing when they see value, when Honeywell sees value. And so I thought that was really good. I want to move on and I want to talk about the sales by segment. So this is a diversified industrial conglomerate. By no means am I fully aware of everything that they do. I'm looking at it at a high level now. I mainly know them as a consumer. I own Honeywell. How many do we have? We have 3 different Honeywell humidifiers. We have one for each bedroom that we have. And the reason for that is we always want to have it ready, because when someone gets sick, and we're getting into that season, fall time, winter time, it's going to happen. We want to be ready and have a humidifier, because it always helps us sleep better at night if we have a runny nose or we're feeling congested, to have a humidifier running. So it's a good thing. I always, of course, buy the genuine Honeywell air filters, so the Honeywell replacement air filters for those humidifiers as well. So we got 3 of those. We have a new hot water heater that we installed earlier this year. One of the expensive costs of home ownership. Our old one broke. The new one is a much better quality, and it has a Honeywell gizmo on the front that regulates the temperature. So that was cool to see. We have a Honeywell thermostat in the house as well, and I love Honeywell thermostats. I am not a smart thermostat person, because I don't want Big Brother out there in our house, Internet of Things, this and that. And so I like more of a traditional thermostat, and I know Honeywell makes a really good one. And so Honeywell products, by the way, they're never the best looking, they're consumer products, and I know consumer products is a small sliver of their business, but I just have experience with that, and I have always found that they are durable and they last you forever. We also have this mega air purifier thing, and we have that from Honeywell with the genuine Honeywell filters, replacement parts, only by OEM, Thug Life all the way, OEM. And so no skimping here. Genuine Honeywell, all the way. And so anyways, what happens here where I live in NorCal is this usually happens like once a year. Somewhere out there, unfortunately, there will be some kind of air quality issue. It's usually related to a fire, or sometimes even, quite frankly, one year what happened in the Bay Area is there was some kind of like industrial property that unfortunately had an issue with fire, and it put this like chemicals and such in the air. Air quality was bad. Basically, we have air quality issues here once in a while, and so I always want to have an air purifier on standby here, and so proud to own a Honeywell one. And so anyways, the sales by segment. So these guys are in aerospace, they're in building technologies, they're in performance materials and technologies, and they're in safety and productivity. I'm going to show this on the screen. You can see what they're all about, and you can see that aerospace is growing, building tech is shrinking, performance materials is growing, safety and productivity is growing big time. And so, but percent of business, safety and productivity is the smallest, so maybe it's smaller, it has more room to grow. Biggest is aerospace. And so this now, along with United Tech, I got some good exposure now to aerospace, especially with United Tech acquiring Raytheon as well. And so big exposure to aerospace that I've got now, and it's probably a good thing. And so one thing that was interesting, this is just a random note that I saw, but when I was in their 10K, again, you want to be a better investor, thug life investor, one of the most important things that I can suggest is literally read 10Ks. Just spend your time, spend half hour a day, 1 hour a day, read 10Ks. You will get so many insights just by reading. And so one of the things I saw is they have I like this about Honeywell. Companies don't always do this, but they have a table where they literally break out cash flow payments leaving the company in terms of debt payments, in terms of settlements as it pertains to asbestos and environmental stuff. And so it was so interesting to see that these guys do have liabilities. They have payments each year going forward for asbestos related issues. And so just something to be aware of. They've been in business forever. They're a tech company. They've built a lot of different materials and products. Unfortunately, it appears they're related somehow to asbestos, and they're paying the price for that, but they're managing that. They're managing it all really well, and they're very upfront with the shareholders about that stuff, and so that was good to see. Now, I want to close out with the balance sheet today. And so balance sheet is where it's really like a bank statement of a company. You get to see what they own in terms of the assets. You get to see what they owe in terms of the liabilities. What I'm going to show on the screen is very simplified. I'm looking at it at a high level here. What I liked to see about this company is in the assets, one area I always probe is goodwill. Goodwill and kind of like intangible assets, I don't value them very high because these days, honestly, is the Honeywell brand name that important? Maybe it is for consumer. Like I just said, I only buy Honeywell on certain things. Quite frankly, I seek out Honeywell. When we were buying, and I'll tell you the story, and I think I told this in a video I did about Honeywell like forever ago, and this is how long I've been looking at this. For a long time, I finally just went for it because I'm not getting a sale on the price, but I feel like, hey, it's going up, but it's still kind of a value in the sense that, well, it's kind of a fair price at a PE of 20, but it's value oriented, I guess, in the sense that they're just growing quickly, and if they continue to grow, I'll be very happy with my purchase price in the future. But I've been looking at it forever, and again, I have loyalty to their products. That's one of the reasons I am looking at this company. I like to invest in stuff I love, but quite frankly, is the government going to be that loyal to their brand name, their goodwill? Is the some other business who's engaging with them? No. And so I don't value goodwill really high. But anyways, they only value their goodwill at about 15 billion of their 58 billion in assets. And so I was okay with that. What I wanted to do, though, is really look at liabilities. And I loved this. For a company of this scale and this magnitude, they only have 39 billion in liabilities. And of that, the long-term debt is only 9.7 billion. And it is down year over year. They're decreasing the debt. They're using some of that free cash flow to reduce debt and their improved metrics that are growing phenomenally to reduce debt. And so this just gave me a signal too. Are they taking out more debt to repurchase shares? No, they're raising the dividend 10 years in a row now, 10 consecutive times at 10% or greater. They're buying back shares, and they're doing this because of their solid performance at the company. Again, this is where investing sometimes gets tricky. Everyone wants the thing that's on sale. Everyone wants the value. Everyone wants the deep discount. I love those kind of stocks too. Thug Life, AbbVie, buying it in the PE range of 7. It's already going back up. Everyone's hyped up on it this week, and I wish it would have stayed down longer. And I got others like that I've talked about recently, such as Cedar Fair. Again, going up. It's going up quickly. I wish it wasn't going up so quickly. But you can't always be that way, in my opinion, as an investor. It's important also for someone like myself, at least, who has both short-term needs in terms of cash flow, but long-term goals as well. This feeds the long-term. This is the company that feeds the long-term in terms of that growth. And so, yeah, PE of 20 ain't great, but it's a line in the sand. And I'm sure that as I continue to dollar cost average in, I'll get a reasonable entry point. And my future self in 20 or 30 years will certainly be thanking my present self for taking the action, drawing the line in the sand, going forth with Honeywell. And so as I close out today, I would be curious what you think. Please share in the comments below in mixing these strategies of kind of value and growth and that whole philosophy. I'd be real curious what you think about that. Please share your thoughts below too, what you think about Honeywell in general. If you like the company, don't like it, I'd be curious. I know some members of the community already own this stock. I've spoken with them about it at our meetups. Now, I just want to share really quickly, by the way, here's some of the Honeywell stuff I've got. What I have here, this is the humidifier OEM filter. I only will buy the OEM filters. And so I have to have these on standby because what happens is these filters, you have to replace them every so often. You can't keep them forever. And I only want to have OEM. So I got these on stockpile from my friends at Honeywell. And this, by the way, is a filter pack. This one is for the humidifier, the big old, this one is for the air purifier, the big old air purifier. And so, again, this is what I could grab quickly for this video. But I really do, never the best looking kind of packaging or such, but something about it, it's just good quality, built well. And so I love Honeywell. Now, before I leave today, I'm going to do my full disclosures. I got a lot of disclosures today because I've mentioned a lot of stocks. So I am long Honeywell, ticker symbol HON. I am long 3M, ticker symbol MMM. I am long United Technologies, ticker symbol UTX. I am long AbbVie, ticker symbol ABBV. Cedar Fair, ticker symbol FUN. Coca-Cola, ticker symbol KO. I am also long, there it is. I am also long Caterpillar, ticker symbol CAT. Leggett & Platt, ticker symbol LEG. And I believe that is it. I am long all of those stocks. All right, everyone. I hope you enjoyed the video today. Please share your comments below. Look forward to discussion around Honeywell and other industrial companies. Thank you for watching. I will see you in the next dividend investing video.